Listen, I need to share something with you that could be the difference between a retirement filled with worry and one where you sleep soundly at night. I'm Peter Lynch, and during my 13 years managing the Fidelity Magellan Fund, I saw my share of market chaos, economic uncertainty, and investors making both brilliant and terrible decisions. I turned $29 million into $14 billion by understanding one fundamental truth. Investing isn't about being the smartest person in the room. It's about being practical, staying rational, and knowing what to own when it matters most. Right now, as we head into 2026, I'm seeing conditions that remind me of other critical turning points in market history. And if you're retired or close to it, the decisions you make in the next few months could determine whether your money lasts 20 years or 40 years. Today, I'm going to walk you through 8 specific investments that retirees must consider before 2026. These aren't flashy. They won't make you an overnight millionaire, but they'll do something far more valuable. They'll protect what you've worked decades to build while providing the income you need to actually enjoy retirement. I've always believed in investing in what you know and keeping things simple. The same philosophy applies in retirement, except now preservation matters more than growth and income matters more than appreciation. Let me show you exactly how to position yourself for whatever comes next. Before I reveal these 8 investments, you need to understand the landscape we're facing. I built my career on understanding cycles, patterns, and what drives markets over time. And right now, several major forces are converging that will reshape the investment environment by 2026. First, we're dealing with interest rate volatility unlike anything we've seen in 15 years. The Federal Reserve is walking a tightrope between crushing inflation and avoiding recession. History tells me they'll probably make mistakes along the way, and those mistakes create both risks and opportunities. Second, demographics are working against us. Every single day, 10,000 baby boomers turn 65 and retire. These aren't people putting money into the market anymore. They're taking money out. This creates sustained selling pressure that will only intensify through 2026 and beyond. Third, we're looking at government debt levels that would have been unthinkable when I started at Fidelity. This debt will eventually require tough choices. Either inflation erodes the debt's value, which hurts retirees on fixed incomes, or taxes go up significantly, which also hurts retirees. Neither scenario is pleasant. During my time at Magellan, I learned to prepare for uncertainty before it arrives, not after. In 1987, I was already cautious about valuations before Black Monday hit. In 1990, I was reducing exposure to overvalued sectors before that recession. The time to build your defense is now, while you have choices, not later when you're forced to make desperate decisions. Investment number 1, Treasury inflation-protected securities. The first investment every retiree needs to understand is Treasury inflation-protected securities, or TIPS. Now, I know what you're thinking. Peter, these sound boring. They are boring, but boring is beautiful when you're trying to preserve capital and maintain purchasing power. Here's what TIPS do. They're government bonds where the principal value adjusts based on inflation. When the consumer price index goes up, your principal goes up. You also receive interest payments based on that adjusted principal. And here's the key protection. If inflation falls, your principal can't go below the original amount you paid. Why does this matter so much? Because traditional bonds are sitting ducks for inflation. If you buy a 10-year Treasury bond paying 4% and inflation runs at 5%, you're losing purchasing power every single year. You might feel safe because the government guarantees your principal, but that principal buys less and less over time. I learned this lesson by watching what happened to retirees in the 1970s and early 1980s. People who had done everything right, saved diligently, bought safe government bonds, suddenly found their retirement income couldn't cover their expenses. Inflation was running at double digits, and their fixed bond payments became worthless in real terms. A comfortable retirement income in 1972 became poverty by 1980. For retirees today, I recommend allocating 20 to 30% of your bond holdings to TIPS. You can buy them directly through treasurydirect.gov or through TIPS mutual funds and ETFs at any major brokerage. The smart approach is to ladder them, buying TIPS with different maturity dates so you have money coming available regularly. One important caveat, TIPS have a tax quirk. The inflation adjustment to your principal is taxable in the year it occurs, even though you don't actually receive that money until the bond matures. This makes TIPS ideal for holding inside tax-advantaged retirement accounts like IRAs or 401k accounts. Let me give you a real example. Imagine a 65-year-old retiree with $500,000 in bonds. If they allocate $150,000 to TIPS and inflation averages 4% over the next decade, that TIPS position will grow to approximately $222,000 in nominal terms. Meanwhile, traditional bonds paying the same interest rate will stay flat in nominal terms, meaning they've lost purchasing power. That difference could mean the gap between maintaining your lifestyle and cutting back. Investment number 2, dividend growth stocks from quality companies. The second investment is something I spent my entire career focused on, high-quality dividend growth stocks. But I'm not talking about just any dividend payers. I'm talking about companies with track records of consistently raising their dividends year after year, especially during tough times. During my time at Magellan, I looked for companies with several characteristics: understandable businesses, strong competitive advantages, excellent management, and most importantly, the ability to grow earnings consistently. In retirement, these same characteristics matter, but with an added emphasis on dividend reliability and growth. Why dividend growth stocks? 3 critical reasons. First, inflation protection. Unlike bonds with fixed payments, great companies can raise prices when their costs go up. Procter & Gamble can charge more for Tide detergent. Johnson & Johnson can raise prices on Band-Aids. Coca-Cola can increase what they charge for soft drinks. This pricing power flows through to higher earnings, which supports dividend increases that help you keep pace with inflation. Second, recession resilience. The best dividend growth companies sell products and services people need regardless of economic conditions. People still need to wash their clothes during recessions. They still need healthcare products. They still consume basic household goods. This means revenues and earnings hold up better than cyclical companies, which supports continued dividend payments. Third, management quality. A company that raises its dividend every year for 20 or 30 years is telling you something important about management. They're disciplined. They're confident about future cash flows. They prioritize shareholders. These are exactly the kind of businesses retirees should own. I always told investors to invest in what you know. Look around your house. What products do you use every day? What companies do you interact with regularly? Often, these familiar companies make excellent dividend growth investments. If you understand the business and can see why people will keep buying their products, you're already ahead of most professional investors. How should retirees implement this? I recommend allocating 30 to 40% of your stock portfolio to dividend growth companies. You can buy individual stocks if you enjoy doing research, or you can buy ETFs that hold baskets of dividend aristocrats, companies that have raised dividends for at least 25 consecutive years. Here's what this looks like in real numbers. A $300,000 investment in quality dividend growth stocks yielding 3% initially would generate $9,000 in annual income. But if those companies raise dividends by an average of 6% per year, which many have done historically, within 10 years your annual income grows to approximately $16,000. Within 20 years, it's approximately $51,000. This growing income stream is what allows retirees to maintain their purchasing power despite inflation. Investment number 3, short-term treasury bills for liquidity and optionality. The third investment might surprise you because it's so simple. Short-term treasury bills with maturities of 3 to 12 months. You might be thinking, Peter, T-bills don't pay that much. Why tie up money there? Let me explain why T-bills are absolutely crucial right now. Throughout my career, I learned that having cash available, what I call dry powder, is one of the most valuable positions you can hold. T-bills provide 4 critical advantages for retirees. First, absolute safety. T-bills are backed by the full faith and credit of the United States government. They're as close to risk-free as exists in investing. When markets get volatile and uncertainty spikes, this safety becomes priceless. Second, liquidity. With maturities of just 3 to 12 months, your money's never locked up for long. If you need cash for emergencies, opportunities, or just living expenses, you have money becoming available regularly without being forced to sell long-term investments at potentially bad prices. Third, competitive current rates. Right now, short-term T-bills are paying around 4.5%. That's competitive with many other safe investments and dramatically better than the near-zero rates we saw just a few years ago. Fourth, and most important, optionality. T-bills give you options. If markets crash, you'll have cash to deploy at better prices. If interest rates spike, you'll have money to reinvest at higher rates. If inflation takes off, you can shift into inflation-protected assets. This flexibility is invaluable. I saw this play out during the financial crisis of 2008 and 2009. Investors who had cash and short-term securities were able to buy incredible companies at once-in-a-generation prices. Meanwhile, investors who were fully invested often had to sell at the worst possible time to raise cash for living expenses or emergencies. For retirees, I recommend keeping 15 to 25% of your total portfolio in short-term T-bills. This serves as your emergency fund, your opportunity fund, and your peace of mind fund all in one. You can buy T-bills directly from treasurydirect.gov or through any brokerage account. The strategy I recommend is laddering. Buy T-bills with different maturity dates so you have money coming available every month or two. This ensures you always have liquidity without sacrificing too much yield. Investment number 4, high-quality municipal bonds for tax-free income. The fourth investment is particularly valuable for retirees in higher tax brackets, high-quality municipal bonds. These are bonds issued by state and local governments, and their interest is typically exempt from federal income tax and often state income tax if you buy bonds from your home state. Now, I need to emphasize high quality here. I'm not talking about speculative municipal bonds from financially troubled cities or risky projects. I'm talking about general obligation bonds from stable states and municipalities, or revenue bonds from essential services like water and sewer systems. Look for bonds rated AA or higher. Why municipal bonds for retirees? The tax advantage can be substantial. If you're in the 24% federal tax bracket, a municipal bond yielding 3.5% is equivalent to a taxable bond yielding approximately 4 6/10%. If you're in the 32% bracket, that same 3.5% municipal bond is equivalent to a taxable yield of approximately 5 1/10%. During my career, I focused primarily on stocks, but I always respected the role that municipal bonds play in a balanced portfolio, especially for retirees who need tax-efficient income. The key is being selective. Stick to high-quality bonds from financially stable issuers. Avoid bonds from municipalities with serious financial problems or unfunded pension liabilities. I recommend that retirees in the 22% federal tax bracket or higher allocate 15 to 25% of their bond portfolio to high-quality municipal bonds. You can buy individual bonds through most brokerages or invest in municipal bond mutual funds or ETFs for diversification. One strategy I particularly like is laddering municipal bonds with different maturity dates, similar to what I recommended for T-bills. This provides regular income, manages interest rate risk, and ensures you have bonds maturing regularly that you can reinvest if rates rise. Investment number 5, blue chip utility stocks. The fifth investment brings us back to stocks, but a very specific type, blue chip utility companies. These are the businesses that provide electricity, natural gas, and water services. They're regulated monopolies with predictable cash flows and consistent dividend payments. I always look for companies with durable competitive advantages, what Warren Buffett calls moats. Utility companies have perhaps the strongest moats of any business. If you want electricity in Duke Energy's service territory, you buy from Duke Energy. There's no competition. This monopoly status, combined with regulatory protections, creates remarkably stable businesses. Why are utilities perfect for retirees? Several reasons. First, inelastic demand. People need electricity regardless of whether the economy is booming or in recession. Usage might fluctuate slightly, but the basic demand is always there. This means utility companies generate steady revenues through all economic conditions. Second, dividend reliability. Utilities typically pay out 60 to 80% of their earnings as dividends. Because earnings are stable and predictable, dividends are also stable and predictable. Many utilities have increased dividends consistently for decades. Third, regulated returns. Utility companies operate under rate structures approved by public utility commissions. These regulations typically allow utilities to earn a reasonable return on invested capital and to raise rates when costs increase. This provides natural inflation protection. Fourth, lower volatility. During market crashes, utility stocks typically decline less than the broader market. They won't make you rich during bull markets, but they won't devastate you during bear markets either. This downside protection is exactly what retirees need. The utility stocks I find most attractive for retirees are large, diversified companies with operations across multiple states strong balance sheets with manageable debt levels, histories of consistent dividend growth, and exposure to growing areas like renewable energy. I recommend allocating 15 to 20% of your stock portfolio to a diversified group of high-quality utility stocks. You can build this position through individual stocks or utility sector ETFs. The key is focusing on quality and dividend sustainability rather than chasing the highest current yield, which can be a red flag for financial problems. Investment number 6, consumer staple stocks. The 6th investment is another category I spent considerable time analyzing during my career: consumer staples companies. These are businesses that sell products people buy repeatedly, regardless of economic conditions. Think toothpaste, shampoo, toilet paper, food, beverages, and household cleaning products. Some of my most successful investments at Magellan were in consumer staples companies because they possess characteristics that generate predictable returns: brand loyalty, pricing power, recurring revenue, and global reach. Companies like Procter & Gamble, Colgate-Palmolive, Kimberly-Clark, and PepsiCo exemplify what retirees should own. These businesses have been around for over a century in some cases. They've survived the Great Depression, multiple recessions, oil shocks, financial crises, and every other economic challenge you can imagine. And through it all, they've kept paying and raising dividends. Why consumer staples for retirement? 4 key reasons. First, recession resistance. When the economy contracts, people might delay buying a new car or cancel a vacation, but they still need to brush their teeth, wash their clothes, and feed their families. This makes consumer staples revenue remarkably stable. Second, pricing power. Strong brands can raise prices to offset cost increases. When inflation pushes up raw material costs, Tide detergent doesn't get cheaper, Procter & Gamble raises prices, and consumers keep buying because they trust the brand. This pricing power provides inflation protection for shareholders. Third, global diversification. Major consumer staples companies operate worldwide. If the U.S. economy struggles, growth in emerging markets can offset weakness. This geographic diversification reduces risk. Fourth, dividend aristocrat status. Many consumer staples companies have raised dividends for 25, 50, or even more consecutive years. This track record demonstrates management's commitment to shareholders and confidence in the business model. I recommend allocating 20 to 25% of your stock portfolio to high-quality consumer staples companies. Look for businesses with strong brands that you recognize and use, global operations, consistent dividend growth, and reasonable valuations. You can build this exposure through individual stocks or consumer staples sector ETFs. A portfolio of quality consumer staples stocks yielding around 3% provides both income and growth potential. These companies typically raise dividends by 4 to 6% annually, which means your income grows over time, helping you maintain purchasing power. Investment number 7, intermediate-term investment-grade corporate bonds. The 7th investment returns us to the bond side of the portfolio. Intermediate-term investment-grade corporate bonds. These are bonds issued by high-quality companies, rated BBB or higher, with maturities of 5 to 10 years. Throughout my career, I focused on stocks, but I always understood that bonds serve a critical role in a complete portfolio. They provide income, reduce volatility, and give you something to rebalance from when stocks get expensive. For retirees, corporate bonds offer several advantages over government bonds. They typically pay higher interest rates because you're taking on additional credit risk, though this risk is minimal with investment-grade companies. Current investment-grade corporate bonds are yielding approximately 1 to 2 percentage points more than comparable Treasury bonds. Why intermediate term specifically? Because they balance yield and interest rate risk. Short-term bonds offer too little yield. Long-term bonds expose you to significant interest rate risk. If rates rise, long-term bond prices fall sharply. Intermediate-term bonds with 5 to 10-year maturities provide reasonable yields without excessive interest rate sensitivity. The key is being selective about credit quality. Stick to investment-grade bonds, rated BBB or higher by major rating agencies. Focus on companies with strong balance sheets, stable cash flows, and durable competitive advantages. The extra yield from high-yield bonds isn't worth the default risk for retirees who can't afford losses. I recommend allocating 20 to 30% of your bond portfolio to a diversified mix of intermediate-term investment-grade corporate bonds. You can build this through individual bonds if you have sufficient capital, typically at least $50,000, or through corporate bond mutual funds or ETFs for easier diversification. One approach I like is buying bonds from companies whose businesses you understand and believe in. If you're comfortable owning a company's stock, you should be even more comfortable owning its bonds, which have priority over stock in case of bankruptcy. Investment number 8, real estate investment trusts focused on essential properties. The 8th and final investment might surprise some people. Carefully selected real estate investment trusts or REITs. Now, I need to be very specific here. I'm not talking about speculative REITs focused on hotels, malls, or office buildings. I'm talking about REITs that own essential infrastructure, medical facilities, warehouses, cell towers, data centers, and residential properties. During my time at Magellan, I invested in companies across all sectors, including real estate companies. What I learned is that location matters, but so does the purpose of the property. Essential infrastructure holds value through economic cycles because the underlying demand doesn't disappear. Why include REITs in a retirement portfolio? Several compelling reasons. First, income generation. REITs are required by law to distribute at least 90% of their taxable income as dividends. This creates high current yields, often 4 to 6% or more, which provides income for retirees. Second, inflation protection. Real estate values and rents typically increase with inflation over time. This means REIT dividends often grow, helping maintain purchasing power. Unlike bonds with fixed payments, REITs provide income that can increase. Third, diversification. Real estate returns have historically shown low correlation with stocks and bonds, meaning REITs can reduce overall portfolio volatility. When stocks and bonds both struggle, real estate often holds up better. Fourth, professional management. REITs are managed by professionals who handle property selection, maintenance, tenant relationships, and all the headaches of real estate ownership. You get real estate exposure without being a landlord. The types of REITs I find most appropriate for retirees are medical office buildings and healthcare facilities, because demand for healthcare increases as the population ages. Industrial warehouses and logistics centers, because e-commerce drives sustained demand for distribution facilities. Cell towers and data centers, because our digital economy requires constant connectivity and data storage. Residential apartments and growing markets, because people always need places to live. Avoid REITs focused on retail malls, hotels, or office buildings, which face structural challenges from e-commerce, remote work, and changing consumer behavior. I recommend allocating 10 to 15% of your total portfolio to a diversified basket of high-quality REITs focused on essential infrastructure. You can invest in individual REITs or REIT ETFs for broader diversification. One caution: REIT dividends are typically taxed as ordinary income, not at the lower qualified dividend rate. This makes REITs ideal for holding in tax-advantaged retirement accounts. Now let me show you how to combine these 8 investments into a complete portfolio designed for retirement security and income. Let's assume you're a 65-year-old retiree with $800,000 in savings. Here's how I would structure it. Bond allocation, 45% equals $360,000, $80,000 in tips, laddered across different maturities, $120,000 in short-term T-bills, creating a 3 to 12-month ladder, $60,000 in high-quality municipal bonds for tax-free income, $100,000 in intermediate-term investment-grade corporate bonds. Stock allocation, 45%, equals $360,000. $120,000 in dividend growth stocks and aristocrats, $72,000 in blue chip utility stocks, $90,000 in consumer staples companies, $78,000 in a diversified broad market index fund. Real estate allocation, 10% equals $80,000. $80,000 in essential infrastructure REITs. This allocation provides multiple layers of protection and income. The bond allocation offers safety, liquidity, and tax-efficient income. The stock allocation provides growth, dividend income, and inflation protection. The REIT allocation adds diversification and higher current yield. Expected annual income from this portfolio, approximately $14,400 from bond interest at 4% average yield, approximately $10,800 from stock dividends at 3% average yield, approximately $4,800 from REIT dividends at 6% average yield. That's approximately $30,000 in annual income, or $2,500 per month before Social Security. Combined with Social Security benefits, most retirees would have comfortable income while preserving their principal and maintaining purchasing power through dividend and rent growth. Here's something critical that many investors miss. These 8 investments aren't set it and forget it. You need a disciplined rebalancing approach to maintain your target allocation and manage risk. I recommend reviewing your portfolio quarterly and rebalancing annually. This means if stocks have performed well and now represent 55% of your portfolio instead of 45%, you sell some stocks and buy bonds to return to your target. If bonds have rallied and stocks have fallen, you do the opposite, selling bonds and buying stocks. This disciplined approach forces you to sell high and buy low automatically, without trying to time the market or predict the future. It's a mechanical process that removes emotion from investing, which is often where retirees make their biggest mistakes. During my career, I saw countless investors abandon sound strategies because they got emotional. They panicked during crashes and sold at the bottom. They got greedy during rallies and bought at the top. The rebalancing discipline prevents both mistakes. Let me return to why timing matters so much right now. Several factors make the next 6 to 12 months critical for positioning your retirement portfolio. Current interest rates on T-bills, TIPS, and corporate bonds are the most attractive we've seen in 15 years. If rates drop because the Fed cuts aggressively, you'll miss these yields. If rates spike in a crisis, quality bonds may be harder to access. Either way, locking in today's rates makes sense. Quality dividend stocks are reasonably valued now. They're not cheap, but they're not expensive either. If markets crash, you might get better prices, but you'll be buying during panic when making good decisions is harder. If markets rally further, you'll pay more for the same quality. REIT prices have corrected from their peaks, creating better entry points than we've seen in several years. As inflation concerns moderate and interest rates stabilize, REITs could revalue higher. Demographic pressures are intensifying. The retirement wave is accelerating, not slowing down. Every day you wait, more boomers are shifting from accumulation to distribution, creating sustained selling pressure. Policy uncertainty is increasing. Elections, fiscal policy debates, and geopolitical tensions all create uncertainty that could force your hand later. Positioning yourself now under current rules provides certainty. As I wrap up, I want to share a principle that guided my entire career. Investing isn't about being brilliant. It's about being consistent, rational, and aligned with your goals. When you're retired, your goal shifts from building wealth to preserving wealth while generating income to support the life you want to live. These 8 investments accomplish exactly that goal. They're not exciting. They won't beat cryptocurrency or the latest tech stock. They won't give you bragging rights at parties. But they'll do something far more valuable. They'll provide safety, reliable income, and peace of mind during what should be the most enjoyable years of your life. I've seen too many retirees chase performance in their 60s and 70s, taking risks they couldn't afford, and end up at 80 with far less security than they should have had. The greatest risk in retirement isn't missing out on gains. It's suffering losses you don't have time to recover from. Own these 8 investments, build your portfolio with discipline, rebalance regularly, and spend your retirement years living life rather than worrying about money. That's the real return that matters most.